Welcome to ValueVest Daily. Today, we are tackling a really fascinating paradox in one of the absolute hottest AI infrastructure stocks on the market, Astera Labs.
So get this, the company just posted incredible earnings. I mean, the kind of numbers investors just dream about. And yet, the stock plummeted. We're going to dig in and figure out exactly why that happened and, what it could mean for you as an investor.
I mean, just look at this number for a second. 92%. That's year-over-year revenue growth in the fourth quarter. That isn't just growth, folks. That's the kind of explosive expansion that basically defines its entire AI boomerang.
But then, this happened. This was the market's reaction, a drop of more than 10% after hours. So what gives? This is the paradox we are here to solve. How does a company completely crush expectations and still get punished for it?
Okay, let's dive right into this. Here's our game plan for today's deep dive, where we are going to unpack every single piece of this puzzle. We'll start with the paradox itself, then we'll get into what Astera Labs actually does. We'll decode those earnings, weigh the bull case versus the bear case, project out to 2030, and finally, give you our verdict.
So the most important thing to get our heads around is this central conflict. Phenomenal results met with a really punishing market reaction. We're going to explore why this wasn't really about the fundamentals, but more about optics. It's a classic case where the market has already priced in perfection, which just means it expected amazing results and it got spooked by even the smallest hints of uncertainty in the future.
So first, who in the world is Astera Labs? Well, they're a relatively new company, but they are a critically important player in the AI space. To really get their value, you have to picture those massive, city-sized data centers built by companies like Google, Amazon, and Microsoft.
The company's journey has been an absolute whirlwind. It was founded back in 2017 by some veterans from Texas Instruments, and they just went public in March of 2024. And they wasted zero time. They immediately became a key supplier to the hyperscalers, the giants building out all the AI infrastructure. And looking ahead, they're already set to deploy their next-gen memory solutions with Microsoft Azure by 2026. I mean, the pace they're moving at is just incredible.
So at its core, the company provides what you can really only describe as the intelligent plumbing for AI data centers. Think of it like this. You can have the most powerful GPUs in the world, but if they can't talk to each other or to the memory and storage at lightning speed, they become totally useless. Astera builds the high-speed, intelligent hardware and software that just eliminates these data bottlenecks.
And this so-called plumbing is made up of a few key product lines, and each one is purpose-built to solve a very specific problem. Their Aries retimers, they're the gold standard for connecting GPUs using PCIe. Their Taurus product handles the super high-speed Ethernet connections between server racks. Scorpio is their big bet on switching, which helps scale out the entire data center fabric. And then there's Leo, their cutting-edge CXL product that lets processors share and expand memory, a totally critical function for these massive AI models. You can see how each piece of the puzzle addresses a growing and very, very valuable pain point.
Okay, now let's get to the numbers that caused all the commotion. This is the Q4 and full year 2025 earnings report. These are the numbers that, on the surface, should have sent the stock to the moon.
And these numbers, wow, they tell a powerful story. Let's just take a minute here. Look at the full year revenue for 2025, $852.5 million. That is up 115% year over year. They more than doubled their entire business in just 12 months. Now, if we zoom into just the last quarter, Q4, revenue was up a staggering 92%. Non-GAAP earnings per share, a really key measure of profitability, was strong at 58 cents. And crucially, when you look at their guidance for the next quarter, they're pointing to continued growth. On paper, everything here is just screaming health and momentum.
So if everything was so good, why the drop? Well, it all comes down to worries about the future, not about past performance. First, the gross margin guidance for Q1 was about 74%, a little step down from the 75.7% they just posted. For a high-growth stock, any hint of margin compression gets put under a microscope. Second, there's a warrant accounting item. It's basically a financial thing related to their big deal with Amazon that's also going to impact those margins starting in Q2. And finally, they're ramping up R&D spending to stay ahead of the competition. So the market heard margin pressure, and for a stock that's priced for perfection, that's all it took to trigger a sell-off.
And this brings us right to the core of the investment debate, weighing this powerful growth story against some very real risks and a sky-high valuation. So is that growth potential really worth the premium the market is asking for?
To understand the risks, you really have to start with the valuation. And this chart, it just perfectly captures the premium the market is assigned to Astera Labs.
The stock trades at a forward price-to-earnings ratio of around 80 times. To put that into perspective, the industry average is less than half of that, at around 35. This tells you that massive future growth is already baked into today's stock price.
Now let's put it right next to giants like Broadcom and AMD, and you can see that premium in even more detail. Astera's forward PE of around 80x just towers over Broadcom's at 35x and AMD's at 38x. Their valuation is also way higher than the industry average based on future revenue. So why? Why would the market pay so much more? The justification is right there in the last row, gross margin. At over 75%, Astera's margins are way higher than its peers. This means for every dollar of sales, they keep more as gross profit. The market is paying a premium for a business that's not only growing much faster, but is also structurally more profitable with every sale. That is the core of the bull argument.
So this brings us to the core debate. The whole investment thesis really hinges on whether these bullish catalysts can overcome the risks. On the bull side, the case is super compelling. Their new Scorpio X switch starts ramping up in the second half of 2026, the Leo CXL memory product goes into production, and their total market opportunity is projected to be over $25 billion. But the risks are very real. Most of their money comes from just a few huge customers. Competition from heavyweights like Broadcom and NVIDIA is a constant threat. We already talked about the margin pressure, and then there's the news that came with earnings. The CFO is leaving. A C-suite change can always create uncertainty. And with that sky-high valuation, any little stumble could lead to a really significant drop.
So what could this company actually be worth in the future? Well, we've mapped out 3 potential scenarios based on how well they execute through 2030. Now, this isn't a prediction, but it's a framework for thinking about the potential outcomes.
Our base case assumes the company just continues to execute well, capturing a solid share of its market and growing revenue at over 30% per year. This is still incredibly strong growth, and it would get them to somewhere between $3 and $4 billion in revenue by 2030.
And if they achieve that, you're looking at a potential price target range of roughly $170 to $280 per share. That would be some really solid upside from where the stock is today.
Now, the bull case is where things get really exciting. This scenario assumes that Astera not only continues to lead in its core markets, but also manages to capture a significant 15 to 20% share of the massive merchant switching market. If they pull that off with their Scorpio product and add in success from future products, you could see revenues push beyond $5 billion.
In that scenario, the stock price could go to $400 per share or maybe even higher. This is the outcome that investors buying today are really hoping for. And, it relies on near-flawless execution over the next 5 years.
And just a very important reminder before we give our final verdict. This analysis is purely for educational and informational purposes. It is not financial or tax advice. You should always do your own research and consult with a professional before you make any investment decisions.
Okay, so what's our final verdict on this Astera Labs paradox? After digging through all the numbers, the products, and the market reaction, how should we be thinking about this company?
We believe this quote from our research just sums it up perfectly. Astera Labs is the indispensable connectivity layer for the next generation of AI infrastructure. That after-hours drop was not a reaction to a fundamental breakdown in the business. It was driven by optics, the CFO news combined with slightly softer margin guidance, in a stock that carries a very high valuation.
The core story here is absolutely intact. For long-term investors who believe in the multi-year AI spending cycle, this pullback could represent a pretty compelling opportunity. Which brings us to our final question. With the stock pulling back on news that doesn't really seem to damage the long-term story, could this be the big AI opportunity of 2026? We really hope this deep dive was valuable for you. Please subscribe, like, and share ValueVest Daily for daily learning opportunities before you put your money to work. And one more thing, if there are other high-risk, high-reward opportunities you want us to break down, please let us know in the comments. We'll see you next time.